Over the last 4 years, the Financial Conduct Authority has levied nearly 400 million in fines against financial institutions for anti-money laundering failings. This staggering figure is a result of a series of high-profile enforcement actions detailed in 18 comprehensive final notices. These notices expose a worrying trend of systematic weaknesses in AML compliance across the financial services industry. This video is part 3 of a series in which I analyse all the findings across the 18 notices. So join me as we delve into these 18 final notices and unpack what the FCA have said, what their key findings are, and explore what went wrong and what lessons can be learned. So the FCA investigations have revealed a concerning pattern of AML failings across various institutions, highlighting the critical areas of concerns. This video will focus on 3 key aspects: the role of the Money Laundering Reporting Officer, the MLRO, compliance and oversight failures within the firms, and the contribution of internal audit and external consultants in identifying and helping resolve these issues. Let's start with the findings against the MLRO. As we know, the MLRO plays a pivotal role in ensuring effective AML controls are in place. However, the FCA final notices highlight instances where the MLRO failed to fulfil their duty, contributing to their respective institutions' overall AML failings. In the notices, it mentions a number of specific important aspects of the MLRO role, and those are oversight of AML systems and controls. The MLRO is responsible for overseeing the firm's compliance with AML, the regulations surrounding that, and the internal policies and procedures. And this includes ensuring that appropriate systems and controls are in place to identify, assess, monitor, and manage money laundering risk. They also say a key aspect of the role is reporting to senior management. The MLRO is typically required to provide regular reports to the firm's governing bodies and senior management on the operational effectiveness of AML systems and controls. These reports, of course, help inform the senior management about the firm's financial crime risk profile and ensure appropriate oversight. And they also go on to say that, of course, the MLRO is a focal point for AML activity. The MLRO is that central point for AML-related activity within the firm. They work closely with other departments to provide guidance and support and training on AML matters where needed. So let's have a look at some of the failings called out by the final notices. For ADM Investment Services, the FCA found that ADM MLRO report during the period between September 14 and October 16 were inadequate. They did not provide necessary information for the board and senior management, and they were unable, therefore, to assess the adequacy of the firm's AML systems and controls. They go on to say the reports lacked substantive assessment of AML controls and failed to note compliance deficiencies. They also note that sections were simply copied from previous reports, indicating a lack of thoroughness of review. These reports also did not address issues identified by the FCA in the 2014 assessment of its own controls, the improvement programme, or the remediation activity. It was only after the FCA's visit in 2016, when they gave specific feedback on the quality of the MLRO report, that the MLRO report improved for the 2016 output. There's also examples in Al Rayyan Bank. While the sources don't explicitly mention the MLRO failings, the FCA identified significant persistent deficiencies in the bank's AML control framework during the period that it was being investigated. And given the MLO's responsibility for overseeing AML systems and controls, it's reasonable to infer that their oversight was inadequate, contributing to the bank's overall failings. Also, the lack of internal audit of the financial crime unit for 8 years further exacerbated the control weaknesses, indicating a failure in the third line of defence also. In respect of Guaranteed Trust Bank Limited, the FCA identified multiple failings for GT Bank's AML processes. Many of them directly impacted the bank's ability to meet its regulatory obligations. Now, the sources don't specifically mention the role of the MLRO again, but the comprehensive nature of the control deficiencies suggest inadequate oversight and failure to fulfil the MLRO role's responsibility. The FCA went on to highlight that despite repeated identification of weaknesses in the AML control framework by internal and external reviews, including by the FCA themselves, GT Bank failed to take adequate remedial action. And this lack of action further points to failures in the MLRO's responsibility for overseeing AML compliance. So overall, within the FCA notifications, the FCA noted the critical role the MLRO plays in ensuring effective AML controls within financial institutions. MLRO failures can have significant consequences, increasing the risk that firms being used for money laundering or terrorist financing. They go on to say that inadequate MLRO oversight, poorly prepared reports, and failure to identify and address weaknesses can contribute to the systemic AML control failures. It is worth noting that the FCA final notices review focused mostly on the institutions themselves and their failings, and didn't really go specifically into the actions or inactions of the MLROs per se, but these can of course be extrapolated from the reports. So let's move on to the findings against compliance and oversight. So the FCA consistently raised concerns about compliance and oversight. They pinpointed several recurring issues. Firstly, inadequate risk management frameworks and systems. The FCA repeatedly found firms lacked adequate risk management frameworks and systems to effectively identify, assess, and mitigate money laundering risk. This included weaknesses in areas such as CDD, customer due diligence, EDD, enhanced due diligence for high-risk customers, and ongoing monitoring of customer activity, and also suspicious activity reporting SARS. For instance, the FCA found that ADM failed to implement formal processes for classifying clients according to money laundering risk, leading to inadequate risk assessments. Similarly, Al Rayyan Bank failed to remediate weaknesses in its AML control framework despite being specifically directed to by the FCA. Thomas Bank was found to have AML control framework that did not meet regulatory requirements, including shortcomings in its processes for handling intermediaries and PEPs. Metro Bank failed to ensure that all customer transactions were adequately being monitored, leaving a significant portion of their customer activity unexamined for potential money laundering. These failings highlighted the need for institutions to adopt a risk-based approach to AML, ensuring that their systems and controls are commensurate with the risks that they face. They went on to talk about unclear responsibilities and accountabilities. As we touched on in the first video, the FCA identified a lack of clear responsibilities and accountabilities within AML frameworks as a significant concern. This ambiguity and uncertainty can lead to confusion, inconsistent application of controls, and weak oversight, increasing the risk of financial crime. For example, the FCA found that GT Bank lacked clearly defined roles and responsibilities for senior management in overseeing AML. This was demonstrated by unclear ownership of their look-back remediation exercise. Starling Bank also experienced issues due to lack of clarity regarding responsibility for implementing against their voluntary requirements imposed by the FCA. This contributed to breaching those requirements. To address this, institutions must clearly define roles and responsibilities for AML compliance, ensuring that staff at all levels understand their obligations and are held accountable for their actions. In a number of notices, it was mentioned that there was insufficient resources and expertise. It mentioned that firms failed to allocate sufficient resources and expertise to their AML compliance function. This can result in understaffed compliance teams, inadequate training, and an inability to effectively implement and monitor AML controls. For instance, the FCA found that Credit Suisse FCC function covering EMEA was inadequately resourced during the investigation period. This lack of resource affected the team's ability to manage the volume and the complexity of its work, and that contributed to an inadequate assessment of the financial crime risks. Against Gatehouse Bank, they also under-resourced their compliance function, and it struggled to effectively manage the AML risk despite operating a 3 lines of defense model. So overall, institutions need to ensure their AML compliance function has the necessary resources, including staff and technology, and they are trained to effectively manage financial crime risk. The FCA also noted failure to remediate identified weaknesses. Now, these weaknesses could be identified through internal audits, external reviews, or the FCA supervisory visits. The trouble is, if we don't resolve these things, it can create a cycle of non-compliance that persists, so the remediation of these activities need to be followed through. GT Bank, for example, failed to take appropriate remedial action to address weaknesses identified by its own compliance and internal audit function, as well as those flagged by the FCA in 2014 to 2017 during the investigation. Similarly, Al Rayyan Bank failed to implement key actions from its own remediation plan, leading to ongoing concerns from the FCA. Therefore, it's crucial for institutions to take swift and effective action to address any AML findings identified, ensuring that the root causes are addressed and that systems and controls are strengthened to prevent reoccurrence. The FCA also noted inadequate oversight and challenge from senior management. The FCA fully expects senior management to play a proactive role in overseeing AML compliance and challenging the effectiveness of controls. However, many of the findings showed that senior management failed to provide adequate oversight or challenge, contributing to AML findings. For GT Bank, for instance, it was found to have inadequate senior management oversight of its AML framework, and this was characterized by poorly defined roles and responsibilities and a lack of challenge towards poor management information. Similarly, Santander UK was found to lack appropriate engagement from senior management on AML issues in the early part of the investigation period, and that contributed to the ineffective management of its AML framework. In summary, institutions need to ensure that senior management are actively engaged in AML compliance, setting clear expectations, providing adequate resources, and challenging the effectiveness of the controls. Overall, the FCA's enforcement actions provide really valuable lessons for financial institutions. By addressing these common compliance oversight failings, institutions can strengthen their AML framework, they can mitigate the financial crime risk, and of course they contribute to improving the integrity of the financial system. Let's move on to the findings related to internal audit and external consultancy. So the internal audit department and external consultants can play quite a crucial role in uncovering and reporting AML failings. If we start with internal audits, they often serve as an initial indicator of AML control deficiencies, but sometimes they fail to accurately assess the severity of the findings or assign appropriate risk ratings to those findings. For instance, in the case of Gatehouse Bank, internal audit reports did expose the issues with KYC procedures for wealth management clients, particularly the bank's reliance on self-certification for source of wealth and funds without proper verification. This triggered a compliance review and eventually led to the FCA's investigation. Similarly, GT Bank's internal audit function consistently highlighted weaknesses in the bank's AML controls throughout the relevant period of the investigation. However, despite these early warnings, internal audit were not always effective in preventing or promptly addressing AML findings because either they were ignored or not followed through on. Also, in some cases, the internal audit reports failed to accurately classify the severity of the identified failings and assign the appropriate risk rating. This sometimes led to a false sense of security among senior managers and sometimes delayed remediation effort. As a stark example of deficiencies against internal audit, Al Rayyan Bank were absent any internal audits of their financial crime unit for 8 years, and that allowed weaknesses in their bank's AML control framework to persist, of course increasing the risk the bank was being used for financial crime. When we look at external consultants, external compliance consultants were often engaged by institutions to provide specialist expertise and conduct in-depth reviews of AML systems and help with the remediation activity. These consultants often provided valuable insight and recommendations that helped institutions improve their AML framework. For instance, for ADMI, they engaged external consultants to assist in redrafting their AML policy and procedures following the FCA's identification of significant failings. In the case of Commerce Bank, an external skilled person was appointed by the FCA to review specific aspects of the bank's AML framework, and they highlighted weaknesses in areas like CDD, EDD, and transaction monitoring. External consultants also played a critical role in assessing the effectiveness of remediation efforts and identified gaps in the AML controls. So in summary, by effectively leveraging internal audit and external consultants, financial institutions can better detect and address AML vulnerabilities, and that helps them minimize their exposure to financial crime risk and helps foster a culture of compliance. So summarizing this video 3, the FCA's enforcement actions provided a stark warning financial institutions about the importance of robust AML compliance. The reports underscore the need for strong leadership and clear accountability within AML frameworks, particularly for the MLRO. Comprehensive risk management systems, sufficient resources, and skilled personnel to effectively combat financial crime. Proactive engagement from senior management in overseeing and challenging AML controls. Swift and effective remediation of identified weaknesses to prevent recurring issues. And by learning from the mistake of others, financial institutions can strengthen their own AML frameworks, protect themselves from hefty fines, and play their part in safeguarding the financial system from criminal activity. Thanks for watching, and if you enjoyed the content of this video, please like and subscribe, and click on the notification bell to be advised of future videos. The next video will cover the key findings within the final notices that relate to management responsibility and accountability and management information. I hope to see you then.